presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for December 20th, 2022. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. First of all, I want to wish all of you a very happy holidays and a great new year. So enjoy the holidays, relax. I know it's busy, it's hectic out there, but just take your time. Enjoy all the festivities and all the great feelings out there. Let's start with the market. The Fed this week, not a lot since last week when the Fed said they're going to continue to raise rates, and they raised the dot plot. You heard me talk about that. It's not what the Fed was going to do. They're expected to raise interest rates by 0.5%, but where would be the terminal rate? Where are they going to stop? Previously they had said 4.6. Now they've raised it to somewhere around 5 to 5.25. That's about 0.5% higher than previously thought. The market didn't like it, and since then it has been going down. Today was a positive day in the market after 4 negative days, but we have failed again at a critical level. I'll take a look at the charts a little bit later on. Talk about the market. We'll talk a little bit about the economy, take a look at the technicals, take a look at the market meter and the week ahead. So let's start with the Fed this week. The Fed target rate, upper bond performance, recessions. Well, we've seen the first cut by 400 basis points. The first 24 months after a recession starts. So I think from where we're going to lower rates, we're ways away from that. We first got to go into the recession that everybody's been looking for the last year. We haven't had that yet. We are going to have a slowdown. How deep is the slowdown going to be? Is it going to be a recession? That depends on how much the unemployment rate goes up. The unemployment rate only goes from 3.7 to 4 to 4.25. I think that will not be a very deep recession. If the unemployment starts to go up even higher than that, then we're looking at a much broader recession. Looking at the market, asset performance this year, looking at cryptos, well, they have gotten killed absolutely. Usually when the stock market goes down, that's this dark blue line, the bond market goes up. But this time, bonds and stocks both went down this year, and that caused one of the worst performances in the stock market, especially if you had a bond and stock portfolio. If you only had a stock portfolio, then the market is down and you're down. But if you had a bond portfolio, usually when stocks go down, bonds go up. So that buffers the downside. This time both went down because rates had nowhere to go but up. And that's interest rates went up, stock market went down at the same time. And that is why we saw a little bit of a lag in the performance. But again, if you're down 10, 11 to 10% or so for the year, you've gained so much more over the last 2 or 3 years in the market, you've given only a portion of it back. But if you're down 30 or 40%, then you have a problem with your portfolio. You had too much risk, that's all it is. And you got killed in the market. And it'll take you years and years and years to get back if you ever do. It's like the dot-coms. People bought them, they did well, they gave it all back and then some. People bought crypto. They made some money, they gave it all back and then some. Now they're not only concerned about making money, they're just worried about getting their money back. If it was FTX or one of those tokens, it's gone, it's zero now. You're not getting anything back, and that's unfortunately the reality of that situation. Market breadth is bullish. That means breadth outlook since August, even though price has not gone up. That is the breadth weakened in months prior leading up to the last peak. That's what we saw, but now we've seen the breadth, the 200-day moving average percentage of stocks above 200-day has come back up. So we are starting to see the internals of the stock market get better. That's why I thought that 3,500 was the bottom in the market. I was hoping that we'd get above the 200-day and stay above it. Again, we failed, so now we're seeing this pullback. Looking at the economy, we're starting to see goods inflation has been coming down. So inflation has peaked. I talked about that earlier on in the year. We thought June or July would be the peak. That's where we've seen the peak inflation has been coming down. Once the inflation comes down, that's when the Fed can take the foot off the brake. Well, they've taken some of the pressure off the brake. They've gone from 75 basis points to 50 now, where they're increasing rates at a slower rate. Hopefully they'll only do it once or twice again, and it'll be only 25 basis points. I think as the economy slows, the Fed is going to very quickly say, okay, we are done. As soon as the Fed says they're done, the market takes off to the upside. That's how it will work. If you're waiting for that to happen, It'll be gone by the time you realize it has happened. So you have to be in the market before the fact. Maybe you'll have to suffer through a quarter or two as the market bounces around, but this is the time to start picking the good stocks that you want in your portfolio. Looking at the unleaded gasoline prices, you can see that they were above 5. They've come all the way back down. And that was the big hoopla. Oh my God, nobody's going to be able to buy groceries because they have to fill their tank. Nobody's talking about that anymore. No one's talking about inflation anymore because people know inflation's coming down. Next thing there will be the recession, and oh my God, unemployment's going up. But if it's not a deep recession, it's not going to be bad. Don't forget, you can get the daily edition of Market Wrap simply by going to the iTunes Store, to the Apple Store, to the App Store, and type in this entire word, Market Wrap with Mo Ansari, and you can get the free app. And then once you get the free app, you get the broadcast every day, 1 hour with great guests downloaded directly to your phone, and you can listen to it at your convenience. Looking at the technicals, we saw interest rates get up to about 4.5%, right about here, 4.4. They came all the way down to about 3.4%. They've come down 1%. This is the interest rate on the 10-year note. That's what we saw, and now we've come back up. I think the market got a little bit overdone. But the bond market is saying, look, the economy is going to slow. That's why interest rates are coming down. That we don't want it to go down too far below 3%, otherwise that'll show that the economy is really going to slow and we're going to have a deeper recession. You sort of stay here between 4.5% and 3.5% and bounce around here like we are. I think the market can handle that right now. The S&P, here's the weekly technicals on the S&P, or here's the daily chart. We got here to the 200-day moving average. This was in August and failed and came down from 4,300 down to 3,500. Then we rallied back above here, above the 200-day again at the beginning of this month. Last week, one day when the Fed made the announcement, we hit 4,100, but here we are now at today down to 38.21 is where we are all the way down to here. We have a little bit of support here, about 3760 or 3,700, right about here. And then if we break this on the downside, then there's nothing but to test the 3,500. I don't think we go all the way down. I think before we get somewhere here, we should find a bottom. Still showing a 1, 2, 3, and this is a fourth wave pullback. And we should go, but we've used up a lot of the energy on the downside. So I think it'll be difficult. Now we've got to get above the 50-day. We've got to get above the 20-day. We've got to get above the 200-day. Until we get above the 200-day, which is 4,000, market is still in a sideways to downward pattern. That's the way I'm looking at it right now. Weekly is the same thing. 4083 is the number, and then 4200 is the number that I'm watching. 3900 is the 20-week moving average, and we are below that now. NASDAQ, even worse picture. Got nowhere close to the 200-day, which is right up here. When we got up here, beginning of last month, middle of this month, nowhere close to the 200-day. Now we've started a wave count to the downside. Looks like we're headed back towards the 10,000 mark, 10,088, 10,089. We closed today at 10,500, so 10,100 is not that far. I think the NASDAQ needs to show some strength before we see the rest of the indices moving higher. Again, the number I'm looking at, the dot plot, as long as these dots are above the market, these lines are the market, these vertical lines, these dot plot is above, shows that we're in a bear market. We need to get above 11,875 for the weeklies to turn up. They turned up here, stayed up all the way up to here for about a year and a half, 2 years. Then they turned down at the beginning of this year, stayed down, turned up for a few weeks, and then turned back down again. So we're just back and forth. Looks like we're going to go test the 10,100 area, maybe even get a little bit lower. Oil, everybody got all excited about oil. China is reopening. I said, well, they're reopening, that's great, but they're going to get a lot of COVID cases. And when people start dying, people start to take precautions by themselves. The cities are not closing down. The government is not closing down the cities, but people are going to be very careful going out, especially when they expect 1 million to 1.5 million of people dying in China as COVID spreads, as they get to herd immunity, as they get more people vaccinated. But it takes time to get to that point, like it took us about a year to get there with the vaccinations and with the infections. Combination of both is how we get. Looking at this oil market, resistance is around 76.25. We're right there today. Went up, tested it. I think China people realize the market went up a little in excitement that China is reopening, but now realizing that the reopening could be a two-edged sword. Plus, there was no impact of the caps on oil prices for for Russia, and the war is still continuing with Ukraine. Gold prices had a good day today, popped up about $30, with the Japanese finally widening the band, letting the Japanese yen go up. They didn't increase interest rates, but it's the first time that they're starting to show that they are starting to move towards that, raising interest rates. There's been hundreds of billions of dollars that have gone short the Japanese yen and borrowed against it and bought treasuries. It was a safe trade for 20 years, but now with the yen going up, treasuries going down, that trade will reverse, and that'll put upward pressure on U.S. interest rates also. Japanese have been some of the largest buyers of U.S. treasuries with the carry trade. So with the dollar coming down, that helped the gold market. We'll have to wait and see if it can stay above the 1795 area or not. If it does, that would be a good sign for the gold market overall. Again, if you want to get the daily, weekly newsletter, you can go to our website and sign up for it. That's compak.com, and you can get the access to the weekly breakdown of the markets also. Looking at the week ahead, I think, again, markets are going to look at earnings. We're going to go into very light trading, as a lot of traders will shut down the desks for the year. And again, then we'll start looking at the markets after Christmas and after really New Year. So things are going to really slow down over the next 10 days. I hope you have a wonderful, wonderful holiday, a wonderful Christmas. Looking forward to the new year. Happy New Year, everyone. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.